So over the next few minutes, I'll show you how to model capital sources in our value add apartment acquisition model. Now I'm using beta version 040 of the model. The version you're using may be newer, and that's okay because the base functionality of the model should remain the same. Now what we'll do is we'll head first over to the underwriting tab here, and then click this investment cash flow section, and we'll enter the investment cash flows. Now, in the previous video, we talked through the uses within the investment cash flow section, and here we're going to talk about sources, right? So we have a total amount of uses, roughly 76 million, which covers our acquisition costs, our hard costs, soft costs, financing costs, and we need sufficient sources to cover those uses. And that's both in aggregate, we need the aggregate amount of sources to cover those uses, and then also in timing. We need to time out our sources such that there's sufficient either equity or debt to cover whatever expense, capital costs, uses that we have at any given point in time through the renovation period. So in terms of sources, we have two options, equity or debt. Equity being the capital contributed by the partners, debt, of course, being either mortgage debt, mezzanine debt, or otherwise. And so in this particular exercise, I'm going to include GP equity, general partner equity, LP equity, or limited partner equity, and then two tranches of debt. Some senior debt secured by the in-place value of the real estate, and then mezzanine debt. And mezzanine debt is not secured by the real estate, but instead secured by the entity that owns the real estate. The mezzanine debt will help fund some of the renovations. And then once the property is stabilized, or meaning all of the renovations are complete and we have a new value for the property based on some increase in rents and greater efficiency of the property, we're actually going to take out the existing debt, refinance that debt with permanent debt. And I'll show you how to do that using this tool. So starting with equity, a couple things we're going to note. First, the name of the equity, GP equity and LP equity, is set for you. We then have funding order, and we're going to play around with that to fund the capital sources as we expect them to fund in the real world. We have share of equity, and this is the percentage of the required equity that each partner, whether GP or LP, contributes to the venture. And then based on these blue font cells, those assumptions, we have the GP equity required amount, LP equity, and the total equity. And the difference between that and the total uses or the required sources would be the required debt. Now in terms of debt, this we have blue font cells, and it allows you to add some names here. So I'm going to leave senior, actually I'll call this senior mortgage, and then I'll call this mezzanine loan. And in terms of share of equity, the GP will contribute 5% of the required equity. The senior mortgage will be 65% of the total cost of the project. So I hit 65, and that results in 76% of the acquisition price, right? The purchase price in time zero, the unrenovated value as we view it of the property. And then the mezzanine loan, we're going to put at 5% of cost, which is roughly 3.8 million. If we come up here and we see the hard costs and soft costs combined is roughly 9 million. So we're talking 3.8 out of 9 million, less than 40% of the renovation cost, the balance being covered by equity. And with those assumptions in place, we get 49.4 million in senior mortgage, 3.8 million in mezzanine loan. That's 53.2 million of total debt. That combined with our 22.8 million of equity gets us to our $76 million of sources, which matches our uses. So the last thing we need to do then is time out these sources to match our uses. And so what I'll do here is I'm going to set senior mortgage to 1, and this is the funding order. Second, we will have the LP equity go out. That way the bulk of the LP equity is secured by the initial value of the property, and then The GP equity will go out in order 3. Actually, let's reverse that, right? And that way, GP equity is happening first, LP equity second. And so if we look out here to the right, what we see is GP equity, all of it happens in time 0. LP equity contributes what it needs in order to cover the requirements, the uses in time 0. And then the LP equity contributes from there up until it's contributed its total required contribution, after which the mezzanine loan begins to fund. Now, out here to the left, we'd set the funding order for mezzanine at 4. And again, the result is month 15, the mezz loan begins to fund, and it funds through to the end of our renovation period, month 36. So in month 36, our mezzanine loan is fully funded, such that we have a sum of our sources of $76 million. Now, what happens? Well, month 50 is when the analysis period currently ends. And right now it's set to sell at the end of month 50. Well, let's say we wanted to run a 120 period analysis. Well, instead of having it month 50, and we can change the analysis period up here. So right now it's just set to month 50, which by default there's a formula in here that takes stabilization and adds 12 months. Let's just do 120 months. Okay, so in month 120 we have the sale. As we come down here, then by default, the senior loan in our initial capital pays off in month 120, and so does the mezz loan, but we don't want that to happen. We actually want this in month 37 for that to pay off. The IO period is also 37. There's no amort, so that doesn't matter. We then set some rate. Right now it's set to variable, and I'll leave that for variable. And what we would do is out here to the right, if we wanted to model out our floating rate, we would set some assumptions here so that our rate would change each period based on where we think rates are going to go over, 37 months. And then the same for our mezz loan. And our mezz is a 10% rate. And again, I'll just leave this, but you can change this as you see fit, such that our annualized rate for each month would change. All right. Now the interest is calculated on a monthly basis, but this would be the annual rate in each of the months. Now, if you wanted to change this from a variable to fixed, you just simply do that. In fact, let's leave the mezz loan as variable, but let's set the senior mortgage as a 4% rate, like so. Okay. However, we want the term ends in month 37, right? So we need to pay off these loans in that month. So we just hit here refi, click the refi button, and what appears now is subsequent financing. And I'm just going to assume one loan. So I leave that to 0% LTC. And then we need a sufficient loan here to cover what, 53.199,825 million. And right now this is by default paying off both the senior and the junior loan from that initial financing. Just so happens it's 70%. We could also assume a higher amount. So let's say that, because right now this 70% is 60% LTV, right? The loan to value at that point. Let's say we wanted that to go closer to 65. So we're just gonna kind of eyeball it. All right, so 75.8. All right, so that gets a 65% loan to value. And what will happen now is there will be 4.5 million of proceeds that will be distributed to the partners in that month 37. And then this loan is amortizing, so no IO. It's amortized on a 30-year schedule. The rate will set also to fixed, and we'll put this rate also at 4%. And then what we see is this loan funds again in month 37, which we'd expect it to. There is no junior loan, so we can ignore that. There's 1% of fees. And then this tells us what the debt yield is on this loan, what the debt service coverage is, funding amount, payoff amount, because it's amortizing. And with that, we've modeled subsequent financing to take out that initial financing. And we have sufficient capital to cover both our renovation period and then our permanent stabilized period. If you have any other questions about capital sources in our value add apartment acquisition model, feel free to reach out. Otherwise, thanks for your time today.